Hello friends, welcome all to my channel Sensex Ka Funda. If you're visiting for the first time, please subscribe to my channel. Today in this episode, we are going to talk about a very important topic about a very worrying issue for the Indian stock markets, that about foreign institutional investors selling in Indian equity markets. This episode focuses on why FII selling may increase in the near term as the rupee depreciates. I discuss how a declining rupee impacts FIIs. I would like you to watch this video later on the RBI's secret strategy to defeat the Trump tariffs. This video here speaks of how RBI is going to allow rupee depreciation to protect exports. It's explained in a very simple language so that everyone can understand. The rupee has weakened significantly against the US dollars. If you see now, the rupee is trading at 88. As per the RBI website, the rupee is trading at 87.85, which is the lowest for us. The worst impact of this is on the stock markets, with FIIs pushing the sell button. Today, if you see, the rupee has hit 87.85. Have sold 8,300 crores worth of equity assets. In fact, if you look at August, how the pace of selling has increased. On August 1st, FI sold 1,926. It increased to 3,666. It's more sells than buys. If you see here, there was some minor buying. Here, there was some minor buying. Here, there was some strong buying. But apart from that, the pace of selling has been increasing. 3,600, 6,516, and now 3,856 on August 28th, and August 29th it has touched the highest of 8,312 crore. If we look at how the FIIs have been doing over the last few months, if you see in August, they have sold heavy selling of 28,840 crores. In July, the sales have been 24,723 crores. There have been buying in June, May, April and March, but the buying has been subdued compared to the previous sell of 46,600 in February and January of 72,676. So in fact, since the beginning of the years, the FIIs have been playing bears in the Indian equity markets. Heavy selling reflects the shock FIIs are facing due to the weakening Indian rupee. As the rupee falls from 80 to 85 per dollar, it means that the rupee has depreciated, and that's not a good thing for them. If $1 used to cost 80 rupees and now 85 or 90, it means that the rupee is getting weaker. And the more rupee falls, the more FII returns in dollar terms gets wiped out. And a small table to explain how the FIIs lose when the rupee depreciates. Let's assume that the rupee is 80 rupees to a dollar. I know it's already at 88, but let's for argument's sake assume that at 80 rupees the FIIs make 100% on their rupee investments. At 82, without doing anything, just by holding the assets in rupees, the depreciation, the returns drop to 97.60. At 85, just by holding, by doing nothing, they have made only 94.10%. So their returns have dropped from 100 to 94.10. At 90, their returns have dropped to 88.90 from 100%. I'm trying to explain here is the more the rupee falls, the more FII returns in dollar terms gets wiped out. From 80 to 90, the returns have dropped from 100% to 88.90% without doing anything. So FIIs are doing the logical stuff. They are exiting the Indian markets to protect their returns. Even if they don't change their portfolio, the falling rupee reduces their gain. At 80 rupees, you saw they earn 100% returns. At 90, it falls to 88%. They earn in rupees but must convert into dollars to repatriate the funds. So weaker rupee means lower dollar returns. If FIIs expect $10 from their rupee earnings, they may get only $9 or even $8 due to depreciation. Hence, they rush to sell before the rupee weakens further. It seems deliberate move by the RBI to protect the exports and allowing the rupee to fall. Pressure and global factors could worsen the rupee's fall. So FIIs would like to protect their profits. This constant FII selling puts pressure on the Indian stock markets. The rupee has appreciation over the last 5 years. It has depreciated from 73 to 88, which is a significant amount of depreciation. So the question is, if the rupee is depreciating, why FIIs still invest in the Indian equity markets? That is because Indian equity markets offer strong net returns compared to other markets. However, the current pace of depreciation is quite alarming. The fall in currency markets that we have seen in one day, it's fallen by 0.63%, in 5 days by close to 1%. So the current pace of depreciation of the rupee is alarming, and SBI had predicted that rupee might touch 90 by the end of Trump term, but it looks like this could happen within the next few months. So if that happens, FI's returns could be wiped out, prompting even more exits. So in this video, I've tried to explain to you why the FI selling might increase in the near term to protect their returns from a falling depreciation of the rupee. Over the next few months, we will see if Trump tariffs are reversed, the FIs may return and may be able to buy the stocks even at cheaper prices. Please follow this channel to be kept updated of the trends that are happening in the equity stock markets. Thank you.